Thank you for joining today's class on Achieving Financial Security, presented by Carolina Foothills Federal Credit Union. Here are some ideas of things to think about for future financial success. The first thing is savings. What types of savings accounts should I have? Retirement. What are my options? Insurance. Why do I need insurance and what should I look for? And college. How do I plan now for the future? The first thing to consider is savings accounts. It is recommended that you have a minimum of 2 savings accounts. However, you can have as many as you need, and you may want to divide the purpose of the savings accounts for more specific projects. One type of savings account is the set-aside savings. This is a savings account to save for unexpected large expenses like a broken appliance, broken down car, down payment for a new car, and many other things. This account should also be used for bills that are paid on a yearly basis, like property taxes and home and car insurance. Another use of this account is to prepare for future home improvements, vacations, and holiday shopping. The key is to make regular deposits to this account. Another type of savings is an emergency savings. This savings is to help you cope with the unthinkable. This savings account is to help you manage with things like job loss, serious injury or illness that keep you from working, or other unexpected life events like birth, death, disability, divorce, and others. So how do you determine how much to save? Dave Ramsey suggests that for your set-aside savings, you make your first goal $1,000, but we know this isn't enough to cover all expenses, so once you reach the first goal, keep adding to it. For your emergency savings, the goal should be more substantial. The first goal is enough to cover your rent or mortgage payment for 1 month. The next goal would be to save enough to cover your bills for 1 month. Once you reach enough for 1 month, the next goal is to cover 3 months of bills. You should also think about saving for retirement. The retirement age keeps changing, and people are working longer because they do not have enough in their retirement to stop working. Here are the age guidelines right now to receive the maximum Social Security payout. If you were born between 1943 and 1954, you must work to age 66. If you were born between 1955 and 1960, you must work till age 66 plus a month or 2 based on your birth date. If you were born after 1960, you must work until age 67. It has also been recommended to increase the age for full benefits to age 70. With today's prices, planning to survive off Social Security benefits is not reasonable, so you must find other sources of money to maintain your lifestyle. Many companies offered company-sponsored retirement benefits, such as a 401k plan. A 401k plan allows the employee to make an automatic payroll deduction into their retirement plan each time they get paid. The payroll deduction for the 401k plan is a tax-free savings that will grow over time through investments. It also may provide you with additional tax benefits when you file your taxes. Find out if your employer matches your 401k contribution and take full advantage of that benefit. You can start out by contributing at least 1% of your paycheck and increase it by 1% each year or whenever you get a raise. These funds can be accessed after retirement to help supplement your income and will be taxed as regular income when you withdraw it. There are also other retirement plans such as an individual retirement account, also known as an IRA. These accounts can be opened easily at most financial institutions or investment firms with a small deposit. There are 2 main types of IRAs, Roth and traditional. You can make deposits into your IRA any time during the year until you reach the maximum contribution amount, which is set yearly by the government. If you name beneficiaries for your IRA, upon your death, the funds will be distributed to the beneficiaries listed. If no beneficiary is named, the funds will become part of your estate and will be distributed through probate court. Many institutions also offer IRA certificates of deposit that earn a higher dividend rate than the regular IRA accounts. A traditional IRA offers a way to save for retirement that might include tax advantages. Contributions you make may be deductible on your taxes depending on your circumstance. Amounts in your IRA are not taxable until they are distributed. Prior to 2020, you could not contribute to this IRA after you turned 70.5 years old. Now you can continue to make contributions if you have earned income. In 2020, you can contribute up to $6,000 unless you are over the age of 50, and then you can contribute $7,000. The traditional IRA is also used to roll over funds from other retirement accounts. Funds can be withdrawn without penalty after you turn age 59.5. After you turn 72, you are required to start taking an RMD, or required minimum distribution, from your IRA. A Roth IRA is an IRA in which you can contribute to at any age if you have taxable income and you meet the income requirements. Contributions to this type of IRA are not tax deductible, which means you pay the taxes up front when you make the contribution instead of later when you withdraw the funds. Funds can be withdrawn at any time, but until you turn 59.5, there is a 10% penalty for early withdrawals. If it is a qualified distribution, such as for the purchase of your first home, the money is not taxed. You are not required to take a required minimum distribution if you are the original owner of the IRA. So which IRA plan do you need? This decision should be based on where the funds are coming from, what the purpose of the fund is, and with advice from your tax preparer. The institution holding the account cannot give you legal or tax advice to determine the type of account you need. You can also visit the website below for more information. Next, let's talk about insurance needs. Many people do not understand the need for insurance, and when they pass away, they leave their families with financial burdens that could have been prevented. The purpose of life insurance is to cover expenses that other family members will not be financially able to cover, like funeral expenses, debts owed, and taking care of children financially. This includes life insurance, short-term disability insurance, and long-term disability insurance. Often young people think that life insurance is for older people. However, the younger you are when you purchase life insurance, the more advantages you have. Preparing for the future is relevant regardless of age. There are 3 main types of life insurance. Each have their pros and cons, and remember that something is better than nothing. AD&D Insurance. This is also known as accidental death and dismemberment insurance. This is usually one of the cheapest policies you can get. It covers deaths not caused by natural causes, such as car wrecks, work accidents, or losing one or more limbs. Each policy pays out differently, so make sure to read the fine print. When you purchase the policy, make sure to designate beneficiaries to receive the benefits so that it does not get tied up in probate court. Term life insurance is another type of insurance. This life insurance has a monthly premium that must be paid to keep the policy active. The premium is set for a specific term. The older you are, the higher the premium, but more than likely the premium is still affordable. Once the term expires, you must purchase and begin paying for a new term policy. There may be restrictions on what the policy will pay out for. Many times, death by suicide is not covered. Be sure to read the fine print. When you purchase the policy, make sure to designate beneficiaries to receive the benefits so that it does not get tied up in probate court. A third type of insurance is whole life insurance. This type of policy is best to purchase when you are young. The younger you are, the lower your premium. Although the premium is higher than the term life insurance, there is not a set term on this one. Policies require you to pay the premium for up to 20 years. Once the premium is paid, the insurance will always be there to cover expenses after death. Many policies also have a cash value. Make sure to read the fine print to know what the exclusions are on payouts. And again, when you purchase the policy, make sure to designate beneficiaries. Short-term disability insurance is insurance used in instances where you cannot work for a period due to illness or injury. Coverage typically lasts about 12 weeks. It requires medical documentation to support the need to be out of work. Many companies provide this insurance at little to no cost. Good coverage is about 60% of your normal take-home pay. Long-term disability insurance is similar to the short-term disability coverage, but it happens after the short-term disability coverage terminates. If the injury or illness is still present and documented, then the long-term disability begins. Like short-term disability, it only replaces a percentage of your take-home pay. Usually good coverage is around 60%. Many companies also provide this at low or no cost to employees. So how much insurance do you need? Your insurance needs change as your life changes. Typically, you want enough insurance to pay off all your debts, cover funeral costs, and take care of children until they turn 18. An insurance agent can help you determine the amount you need and what you can afford. You may be required to have a medical evaluation to determine insurability and premium. Never rely on the insurance you have at work. What happens if you are no longer employed at the company? Always have a backup plan. The last thing we're going to talk about is planning for college. Planning for college needs to begin early. We cannot assume our students will get all the scholarships they need to pay for college. It's estimated that the average state institution tuition will be closer to $100,000 for 4 years soon. Private institutions will cost even more. Sources of payment for tuition include grants, scholarships, student loans, and family savings. Typically, the cost of tuition should be split into thirds, with 1/3 coming from savings, 1/3 coming from scholarships, and 1/3 coming from student loans. Here are some options for saving for college. You can open a general savings account. This is a savings account like any other, where funds can be set to the side for a specific expense. The pros are that the funds are always available, so it can be used for anything. There is no tax reporting for withdrawals. The cons is that funds are always available, so you must be disciplined to use it only for education. Another type of savings is the Coverdell Education Account. This account is specific for education, and the student is the beneficiary. Funds can be used for anything educational, and withdrawals are tax-free if you can prove they were used for educational purposes. The pros are that you're saving for a specific use. It often earns interest, anyone can contribute, and it can be used at any educational level. The cons are that you have a limited yearly contribution amount, and you must prove withdrawals were used for educational purposes. Here are some more options. There is a State 529 plan. These plans are administered by the State Treasurer's Office. They can be opened through the state or private investors. Refer to the South Carolina State's Treasurer's website for more information. The pros for this account is that it is tax deductible, no taxes for qualified withdrawals, it has low impact on financial aid eligibility, a high contribution limit, and anyone can contribute. The cons are that the funds are not guaranteed. Consider all options before getting a student loan. Not saving for college can cost more in the long run. The average student graduates from a 4-year institution with $34,000 in student loans. Many student loans start charging interest right away. Non-payment of student loans can result in federal income taxes being garnished and will have a negative impact on your credit score. Thank you for joining today's class on achieving financial security. If you have any further questions, please feel free to reach out to me, Grace Simonelli, at gsimonelli@carolinafoothillsfcu.coop. Thank you.